If you look in general, the fundamentals of the credit market have not deteriorated significantly. I mean, the interest coverage ratio for most companies looks pretty good. Much like homeowners, they've taken advantage of low rates. They're borrowing at low rates. They're pushing maturities well out in the future. So with interest coverage ratios generally high and no big wall of maturity coming, you probably don't get a big crack in credit until the next recession. So the indicators you need to watch are the ones that we always watch: the strength of the dollar, the shape of the yield curve, and so long as we don't get a major policy mistake in here, it's very unlikely you'll have a big credit event.
What we're seeing here is a de-risking associated with changing pricing of growth. So we went from U.S. growth that was excellent, and we're going to U.S. growth that's average next year. And so we're repricing that as we go. And it's a
average,
question of,
but not recession.
Not recession, that's right. So we're going back to average, and moreover, it's extremely well telegraphed. So policy is driving the train here. So we have monetary policy, as you discussed, fiscal policy waning, trade policy, which is going to have a small growth divot effect on U.S. manufacturing firms. And so all of that is pushing the economy back to trend next year, not into recession. So it's a question of when we price that in fully.
We think the consumer is in the best place it's been in a long time. I think what you have to focus on, though, is the fact that gains are beginning to moderate, right? We've heard that from everyone from Amazon all the way down. So we think you need to focus on companies that have those internal catalysts to improve performance. One we really like right now is Under Armour. Better marketing, better products. So even if the consumer isn't growing as fast next year, these companies have specific catalysts that they can unlock to improve performance.
Investors know that holiday is going to be a good holiday. We're expecting one of the jolliest holidays really for over a decade now. So, I think that investors are already looking out to next year and saying, can this momentum continue? And I think for the better retailers, we believe that it can. One of them being Urban Outfitters, which reported last night a plus 8% comp, beat consensus numbers by 8 cents, and we raised our annual number by 12 cents. So we see them continuing to benefit as we go into next year, particularly as they're at the forefront of the fashion cycle that we're seeing.
There's really been no sign of a bottom yet. Typically a bottom, you see lots of volume, a panic, capitulation. Now, with that said, the past 2 days, we've had steep down openings. That's certainly a sign of capitulation on the short term, so I wouldn't be surprised if we caught a rally somewhere in here. But the longer term prospects, I think we still need to see the market settle down. We need to see improvement in breadth. And I'd like to see the momentum, the downside momentum that has really been so strong through this entire period, broken. And that would require 1 day or 2 days where the upside volume exceeds downside volume by a ratio of 10 to 1 or more. We haven't even seen one of those days this entire year.